You've opened your TFSA. You've filed your first tax return. You have money sitting in your account. Now what? Most new PRS leave that money as cash earning almost nothing, because nobody told them the simple, low-cost way to actually invest it. In the next 8 minutes, I'm going to show you exactly what to buy, where to buy it, and how to never have to think about rebalancing again. This is the investing framework that will build your first $100,000 in Canada. Let's go. Here's the mistake I see almost every new PR make after watching my TFSA and RRSP video. They open the account, transfer the money, and then leave it sitting as cash, or in a high-interest savings account earning 3%. That feels safe. But here's what it costs you. $21,000 sitting in a savings account at 3% earns you $630 a year. That same $21,000 invested in a diversified global equity ETF, growing at the historical average of 7%, earns $1,470 in year 1, and compounds dramatically from there. Over 20 years, that difference becomes over $68,000 in lost wealth. The account is only half the tool. What you put inside it is the other half. Before we get into which ETF to buy, let me quickly explain what an ETF actually is, because if you're new to Canada, your bank branch will try to sell you a mutual fund instead, and you need to know why that is a very expensive mistake. An ETF, exchange-traded fund, is a single investment that holds hundreds or thousands of companies inside it. Buy one ticker like XEQT, and you instantly own a piece of roughly 9,000 companies across the world: Apple, Microsoft, Royal Bank, Toyota, and thousands more. The annual fee, called the MAIR, is just 0.20% for XEQT. Compare that to the typical Canadian bank mutual fund, which charges 1.5 to 2.5%. On a $100,000 portfolio over 30 years, that fee difference costs you over $200,000 in lost wealth. $200,000 just in fees. This is why every serious Canadian personal finance voice, including this channel, points new investors toward ETFs. Here are the 4 all-in-one ETFs that cover 90% of what new Canadian investors need to know. XEQT from iShares, 100% global stocks, MAIR of 0.20%, the top voted ETF in Canada for 2026. VEQT from Vanguard, also 100% global stocks, very similar to XEQT, MAIR of 0.24%. XGRO from iShares, 80% stocks and 20% bonds, slightly smoother ride during market downturns, same 0.20% MAIR. And VGRO from Vanguard, also 8020, MAIR of 0.25%. Here is the decision framework. If you won't touch the money for 15 years or more, go XEQT or VEQT. Pure growth, maximum long-term returns. If a market crash of 30 or 40% would make you panic and sell, step down to XGRO or VGRO. The 20% bond allocation cushions the fall. For most new PRS in their 20 and 30 building toward their first $100,000, XEQT is the answer. The most common question I get after the TFSA video: should I buy XEQT or VEQT? Here's the honest answer from every serious Canadian finance source in 2026, it barely matters. XEQT has a slightly lower MAIR at 0.20% versus VEQT at 0.24%. XEQT has slightly more US exposure. VEQT holds more individual stocks. Both are globally diversified. Both auto-rebalance. Both are available commission-free at Wealthsimple and Questrade. The fee difference on $10,000 is $4 per year. $4. Pick whichever you prefer and buy it consistently every month. The most important factor is not which fund, it's that you start and that you keep going. You have 2 excellent options for where to buy ETFs in Canada with zero or near zero commissions. Wealthsimple Trade, the simplest platform for beginners. Zero commission on all ETF and stock trades. You can start with as little as $1. It takes about 10 to 15 minutes to open a TFSA or FHSA and you can buy XEQT on the same day. The only catch, if you are buying US listed ETFs or converting Canadian to US dollars, there's a 1.5% currency conversion fee. For Canadian listed ETFs like XEQT and VEQT, which is what I'm recommending, that fee never applies. Questrade is the other option. ETF purchases are free, ETF sales cost $9.95. It has a USD account if you want to hold US listed ETFs without the currency drag. If you are a brand new investor, start with Wealthsimple. Open the account, link your bank, and buy XEQT. Done. Here is the actual investing system I want every new PR to run. Step 1. Decide on a monthly amount you can invest without stressing about it. It does not have to be large. $200 a month is a life-changing amount if you're consistent. Step 2. Set a fixed date, ideally the day after your payday, so the money moves before lifestyle inflation can absorb it. Step 3. Open Wealthsimple, buy XEQT. Same ETF. Every month. No market timing. No overthinking. Step 4, and this is the one most people fail at, never sell during a market crash. A crash is not a disaster, it is a discount. You are buying more units of XEQT for the same dollar. The math on the screen right now shows you what consistency does. $500 per month at a 7% average return becomes $260,000 in 20 years. $1,000 per month becomes $1.2 million in 30 years. The strategy is not complicated. The discipline is. Now that you know what to buy and where to buy it, which account should it go into? Your TFSA is first priority. Put XEQT inside your TFSA and every dollar of growth, dividends, capital gains, is permanently tax-free. No tax when you sell. No tax when you withdraw. Nothing. If buying a home is in your plan, put XEQT in your FHSA second. You get the tax deduction on the way in and the tax-free growth and withdrawal on the way out. The RRSP is third. Once your TFSA and FHSA are maxed, the RRSP deduction becomes your most powerful tax tool, especially as your income grows. Only move to a non-registered account if all three registered accounts are maxed. For most new PRS, that won't happen for several years, which means you have a long runway of completely tax-sheltered growth ahead of you. Here's what will happen when you walk into a Canadian bank and ask about investing. They will try to put you into a mutual fund. It will sound professional. It will have a nice name. It will probably have a fee between 1.5 and 2.5%. And here's the brutal truth. After fees, most actively managed mutual funds in Canada underperform a simple index ETF over 10 or 20 years. You pay more. You get less. The bank advisor is not a villain. They're doing their job, which is selling bank products. But you now know better. On $50,000 over 20 years, the fee difference between a 2% mutual fund and a 0.20% ETF is over $22,000. That's money that would have stayed in your account and compounded. Say no to the mutual fund. Open a Wealthsimple account. Buy XEQT. You will experience a market crash. Probably more than one. XEQT will drop 30 or 40% at some point, maybe more. Here's what you do. Keep buying. Every crash in recorded market history has been followed by a full recovery and new highs. The 2008 financial crisis, down 50%, fully recovered in 4 years. The COVID crash of 2020, down 34%, recovered in 6 months. The 2022 rate hike correction, down 25%, recovered within 18 months. The investors who built wealth did not time the market. They did not sell in the crash. They bought more units on discount and let time do the work. The investors who lost wealth did the opposite. They panicked, sold at the bottom, and locked in their losses permanently. Your job is simple. Buy XEQT every month and do not check your account during a crash. Here's the takeaway. Leaving money as cash in your TFSA is costing you tens of thousands of dollars over time. One All-In-One ETF, XEQT, gives you global diversification across 9,000 companies for 0.20%. The system is simple. Open Wealthsimple, buy XEQT, repeat every month. Put it in your TFSA first, your FHSA second, your RRSP third. And when the market drops, keep buying. The strategy works. What breaks it is panic. Don't panic. If this gave you the clarity to actually start investing in Canada, hit like and subscribe to PR Wealth Lab. Comment below, have you opened your Wealthsimple account yet? What's stopping you?